Also, there's a bill that has received royal assent in November, where distributions by listed public companies in consideration for cancellation of shares in a selective capital reduction is unfrankable, but creates a debit to your franking account. So that applies from 18 November 2022. Also, if you raise capital, issue shares, use that proceeds to pay a dividend, then that dividend cannot be franked. However, the capital raise must form a substantial part of the dividend. And only the portion funded by capital raising cannot be franked. So be aware of that integrity measure. Now, normally a dividend reinvestment would meet this condition, but it's not designed to capture regular dividend investments. However, a special dividend, which is reinvested, could trigger this rule. And the timing of when the dividend occurs and where the capital raise is not relevant. I mean, it might not matter. And also, it does not matter if the entity paying the dividend and the entity raising the equity are different entities. So this applies to distributions made on or after 28th of November 2023. So my recommendation to you is whenever you raise equity, it might be worth preparing a memorandum as to how the funds were used. So let's look at two case studies. Company A pays a special dividend. The shareholders can elect to receive the dividends by way of cash or to reinvest the dividend. The dividend reinvestment plan was fully underwritten, and half of the shareholders elected to reinvest the dividends. So this was an example in the explanatory memorandum, and it was expounded that the rule is triggered because half of the shareholders has elected to reinvest the dividends. So basically, you're raising equity, using it to pay the dividends, and the fact that the dividend reinvestment plan was fully underwritten seems to factor into that analysis as well. In the second case, Company A raised capital to acquire a business. Unfortunately, the transaction did not proceed, but the funds were just added to the general pool of funds. 12 months later, Company A decides that it wants to pay a dividend from those funds. So in this case, it is the rule does not apply because it's not reasonable to link the capital raise to the dividend payment. The purpose of the capital raise was to acquire the business.